How to invest in stocks for beginners, index funds and regular investing. Stocks have performed well over the long term. Sometimes share prices can fall for up to 2 to 3 years, but in the end they have always risen slowly. Usually, global stock market crashes are followed by a rapid fall in share prices, while the rise is quite slow and cautious from the bottom up. If you can watch this video to the end, you will learn how you can invest in stocks almost risk-free and get good returns. Regular fund investing means investing a certain amount of money in a fund at regular intervals so that when the fund price goes down, you get more fund shares and vice versa. This way, even if the value of the fund years later is even lower at the time of sale than at the beginning of the investment, the return may have been high. Of course, it is always more profitable to buy a large amount at the low and sell at the high, but it is unlikely that this will often happen in the long run, as predicting peaks and troughs is a gamble. It is impossible to say which fund will perform best over, say, the next 10 years, so it is at least worth choosing a fund with low expenses. These funds are called index funds, which follow a specific index. Low or no expenses are due to the fact that the portfolio manager of the index fund does not buy or sell the holdings of the fund. Such funds usually always invest in the largest and most stable companies. For example, the S&P 500 Index Fund tracks the US S&P 500 stock market index. The following simple calculation and chart explains the idea of conventional fund investing in no-cost index funds. If an investor had initially invested a certain amount of money in a fund whose price had gone like this, he would have lost 20% of the money he invested. If, on the other hand, he had invested the same amount of money in the same fund at regular intervals, he would have made a profit of more than 10%. In other words, by buying the same amount when prices are low, you get more shares and vice versa. Of course, if you owned an omniscient crystal ball and knew that the stock market would rise every year for the next 5 to 10 years in a row, then of course you would immediately put all your extra money into the stock market. The main advantage of regular fund investing over a lump sum is the reduction of risk over time. The fact is that no one knows whether stock market prices will rise or fall in the coming years. An analyst or a bank investment advisor may make analyses and recommendations about different funds, but these are only guesses or hunches about future price movements. Usually, your bank's investment advisor will advise you to buy a fund that is going up. The value of a fund may have risen by 30% in the last 6 months, but over the next 6 months it could fall by the same amount. A regular fund investor, on the other hand, has bought a fund for a small amount at first, bought more for the same amount after a certain period, and so on. There is no need for a big bottom-up when you have already made a profit by investing in this way. Spreading the total amount invested over a long period of time is also a great advantage. If a family has extra money left over, say €10,000 a year, there is no reason to spend it on anything, travel, children's expenses, etc. It is wise to invest this amount in an index fund of, say, €833 per month and do the same in future years. In 10 years you will have invested €100,000. But the return is likely to be the same, interest on interest, calculated at a moderate 8 to 9% annual return. This €100,000 investment has therefore yielded the same amount of money, but you will have to pay tax on it when you sell it. It should be borne in mind that this €100,000 could not have been invested, without incurring debt, in the first year of investment. The rules for regular fund investments do not apply in the same way to individual shares, as the risk of individual shares is much higher. A company's share price can fall by 50 to 100% and the company can even go bankrupt. A fund diversified across sectors, countries, continents and companies with large net assets does not have such a high risk. In addition, in direct individual equity investments, stock performance and the market should be actively monitored. This can be time-consuming and stressful. Losing trades and falls in the price of owned shares are a source of frustration for many. Let's not dilly-dally. Investment guides advise you to buy when the price rises and sell as soon as it starts to fall. This often involves complex technical analysis. Easier said than done. It would be easy to make money if you could always buy at the bottom and sell at the top. In the long run, dilly-dallying yields nothing but high buying and selling costs. Sometimes you make a profit, but soon you make the same amount of loss. It is true that the biggest profits are made by taking small profits and doing so often enough. Or, alternatively, by picking a stock whose price rises by hundreds or thousands of %. These things just don't work for very many people, and they require close monitoring of stock movements, expertise and really good luck. Regular mutual fund investing, on the other hand, requires little or no market knowledge or close monitoring of the market. The requirements of regular mutual fund investing. A long investment horizon, at least 10 years. If you started regular equity investing at the peak, it is very unlikely that prices will fall for 5 years before they start to rise more steadily. Buying shares at regular intervals for a small amount at a time. The advantages of regular fund investing. Price fluctuations allow you to buy more at a lower cost. The ability to diversify your total final investment, even a large one, over a long period of time. The return on your investment is not directly affected by falling or rising share prices in equity funds. Investing small amounts at a time. Many people cannot afford to invest large amounts at a time. Over a long enough period of time, it is almost a sure way to get a good return on your investment. Disadvantages of regular fund investing. In fact, the only disadvantage can be thought to be that you cannot invest large sums in index funds after years of falling stock prices. This has to take into account that many people do not have, for example, tens or hundreds of thousands of euros, without borrowing, which is not advisable, to put into shares, whereas over a long period of time this may well be possible. Choosing the right fund is not an easy task. As a general rule, however, it is worth investing in funds that have historically performed at least reasonably well and whose annual management fee is not very high, e.g. 0 to 0.5% per year. When should you start investing in conventional funds? The timing of purchases is not very important, as purchases are made regularly over the long term and it is difficult to time them optimally to coincide with the bottom of price movements. The longer the period of falling prices, the more fund units can be bought for the same amount of money and the smaller the price rise needed to turn the investment into a profit. You can buy more frequently at your discretion if you believe the bottom of the price is near. Timing of fund sales. As soon as you know that you need or want to use the money you have invested for some other purpose in the next few years, you should start looking for a suitable time to sell. It is important to time the sale of fund units carefully, and the sale can be done in several tranches. It is important to time the sale of fund units at the highest possible price, so that at least too many previous purchases have not been made at a price higher than the future sale price. Naturally, the more you lower the top price, the less you will profit, because you will also have bought units at the top price and the total amount invested will have increased over the years. A drop of just a few percent from the peak price can mean up to 10 to 30% lower profits, depending on the price movements. As a sort of rule of thumb, if the fund price falls more than 20 to 30% from its peak after years of saving, it is worth, if possible, continuing to buy, waiting until the price has recovered from the trough and selling after the rise has lasted for a year, for example, or the fund price has even risen to a new peak. Thanks for watching.